Hello and welcome back to another trader training video. On this video we're going to look at, again, some more details of options and what they are and how we use them. More specifically, on this video we're going to start to connect to the probability distribution that we looked at on a previous video and show how that relates to the option pricing and how we can start to make sensible selections of which option strike that we want to either be a buyer or a seller on. So the first thing that we're going to do is start to look at some of these column headers. Let's focus on the call side for the moment, and just underneath that we can see that there's a column header. What we're going to do is we're just going to change that percentage change. We're going to go down to options, theoreticals and Greeks, and we're going to change that so that it shows the probability ITM. This stands for the probability of being in the money. Now then, if we think back to the probability distribution that we looked at on a previous video, a quick reminder is that we have the current price here and we have the probability of price moving either up or down from the current stock price. Let's have a visual cue of how that looks like. So if we look at a quick chart illustration, if we flip that probability, the bell curve, on its side, we can overlay this on the chart and we can start to figure out what price may or may not do relative to what we think might happen in the future and how that translates to the chart. So what this probability of being in the money column does for us is it starts to give us some percentages of what is likely to happen. And as I'm talking, we can see that the current stock price is still around $120. And this probability of being in the money is essentially those figures, the expressed percentages. So if price was to move to, from 120 to 115, or even up to 125, it tells us what the probability of that happening. Now it gives us the probability of price expiring in the money. So in the next 42 days, it's giving us the probabilistic outcome that price will close 1 cent above being in the money, the strike price that we're looking at. For the moment though, let's just go to the chart, because what we have here, if I just zoom in slightly, we have a visual reference for that. So current stock price is here, and that's that $120 that we just looked at in the options chain. And let me just scroll to the right slightly. And this vertical line here, this is 42 days from right now. So we can go out to that 42 days in time. So every day a new bar will plot, or a new candle will plot. And this upper line here and this lower line here, this is the probability cone that we were just talking about. And this gives us, if we look at this upper band and this lower band here, this is the one standard deviation move, one standard deviation. And that's measured from the current price as it is right now. So the probability of price being inside of this cone at some point is 68.2%. That's what we've already established, because the majority of price movement and price expectation in the next 42 days will 68% of the time be somewhere inside. Now, because of that same probability distribution, we can say as well, to get to one standard deviation, the furthest extreme of that bell curve at one standard deviation, we know that that's going to be approximately 34%. And then down, it's also going to be 34%. It's 34 and change, as we know. But what we do know is that to get that furthest extreme, either up or down, there's a 34% probability that price will close above one standard deviation or below one standard deviation from the current stock price. That's what we're saying. Let's take a look at that on the option chain. It's back to the trade tab. Now I'm just going to dip into the weeklies so that we've got, I don't know if you've just noticed that, but the monthly has the option strikes changing at $5 increments. So I'm just going to go into the weeklies with $1 increments so that we can see how that looks in a little bit more detail. I'm going to focus still just on the call side for the moment. The current stock price is still approximately $120.60, and we've got this shaded area, and this tells us that all these options are in the money. But as these strike prices are out the money, this probability of being in the money, that bell curve, all these strike prices are at different levels on the bell curve. So it's telling us where and what the probability is that that option strike price will expire 1 cent in the money. Again, this is the probability that this option will or this strike price will expire in the money, and that means 1 cent in profit. So, for example, $121.01, $122.01, and all the way down to what we can see here, $128.01. So that would be in the money. It would have 1 cent of profit factored in. So what is the probability of that happening? And we've got all these varying expectations along this probability, the bell curve that we just looked at. Now what we're interested in is where does normal stop and start? Now we've already established that normal is 1 standard deviation, because that represents 34% approximately of our price movements, either up or down. So if it's down 34%, then it's also got 34% that it could move up. Add those together, and that's where we get the 68% and change. I'm just approximating, but 68% of the time price will be inside somewhere 1 standard deviation, 68% of the time. So where's the extreme boundary of that expected range? It's at the 34% either down from the current price or up from the current price. And this probability of being in the money helps us find where normal price distribution stops and starts. And we can just about see that the nearest strike price at our extremes, the nearest strike price to 34% is this particular strike price just here. So $124 is on the call side, so up from the current stock price, that particular strike is expected to be at the extreme end, and that is essentially 1 standard deviation. So the stock price, based on all the things that we know right now, is expected to be somewhere below that level, below $124 in the next X number of days. What this particular strike price is telling us, and that percentage probability of being in the money, is that that is at the extreme boundary of 1 standard deviation. So this is where our normal expectation stops being normal. So any price movements past this particular level, again, we're looking at $124. So the stock price moving past $124 would be considered out of normal, because we know that 68% of the time price is going to be within normal distribution. And what we're saying is we can now put a figure to that expectation. Price to move beyond $124 from its current stock price has a probability of, guess what? Well, right now it's saying 35% because it is in constant change, but there is a 35% probability that that option strike price, $124, will expire in this case, we've just changed the option in 35 days. It will expire 1 cent in the money with a probability of 35%. That's not particularly good expectation. It's low probability. It's worse than 50-50. But now what we get to do is we get to start to put a figure on what is a realistic expectation and an unrealistic expectation. And we can mathematically quantify everything that we do in the time that we have available. Now, let's just think about this for a moment, and we'll leave it on this video. If the probability of the $124 strike to expire in the money is 35%, so in the money, 35%, then the opposite must also be true. For that option to expire out the money and expire worthless, it would be the opposite, and it would be a 65% probability that the option would expire out of the money or worthless. Consider this for a moment. If I know that that strike price will expire worthless with a 65% probability, could I sell that option instead of buying it? Because one of the benefits of the option market is for every buyer there's a seller. And instead of buying that call hoping that price will reach $124 and start to go in the money, I've got a 35% probability that that will happen. Not very good odds. But if I can take the other side of that trade, then I've got a 65% probability that it will expire worthless, which as the seller of that option is how I will get paid, because someone's going to pay me to sell them the option. So as the option seller, I would receive a credit with a 65% probability of keeping all of that money by expiration, which is a good deal. We'll explore this concept further on later videos. With that said, I will see you on the next video.